In the heart of New York City, where fortunes are made and lost, one man's name became synonymous with greed. Bernard L. Madoff was born to a modest Jewish family. They didn't have much, but his early ambitions led him to start his own investment firm in 1960 with just $5,000, a small fortune earned from lifeguarding and installing sprinkler systems. His firm, Bernard L. Madoff Investment Securities, started as a penny stock brokerage, trading low-cost shares. Unlike many of his contemporaries, Madoff embraced the emerging technology of the time, which allowed him to take advantage of real-time stock quotes. Madoff was a pioneer, leveraging cutting-edge technology to create one of the first electronic trading platforms. This innovation set him apart, earning him the respect and admiration of peers and clients alike. This technological edge gave Madoff a significant advantage. He was an early adopter of computer-based trading, which allowed him to offer his clients faster and more reliable service, setting his firm apart from others. To the world, Bernard L. Madoff was a Wall Street wizard, a man whose financial and technological acumen had earned him not only billions of dollars, but also the unwavering trust of the world's elite. And for decades, his investment firm appeared to be a beacon of financial stability and growth. In the 1970s, Madoff's firm grew significantly, partly due to his involvement in developing the NASDAQ stock exchange. His firm became one of the largest market makers, meaning they were one of the companies that facilitated the buying and selling of stocks on behalf of clients, often acting as both the buyer and seller to provide liquidity in the market. By the 1980s, Bernie Madoff had become a titan of finance. His firm was one of the largest market makers on Wall Street, processing up to 10% of the New York Stock Exchange's trading volume. Madoff was not just a financial figure. He was a socialite, rubbing shoulders with the rich and powerful. He served as the chairman of NASDAQ and was a trusted advisor to charitable organizations and educational institutions. His clients included Hollywood stars, international banks, and even vulnerable old people who saw him as a trustworthy guardian of their savings. But behind the polished exterior of Madoff's empire was a labyrinth of deceit. Behind the scenes, Madoff was constructing something far more sinister, a massive Ponzi scheme built on the trust of those who believed in him the most. Harry Markopolos, a portfolio manager for an equity derivatives asset management firm in Boston, was asked to analyze Madoff's money-making methods, and he quickly discovered Madoff was running an old-fashioned Ponzi scheme. I knew something was wrong. The numbers didn't add up. For years, I tried to warn the SEC, but no one listened. They were blinded by Madoff's reputation, by the image he had carefully crafted over decades. The returns Madoff promised, steady, unerring, and almost too good to be true, were precisely that. Too good to be true. Madoff wasn't investing his clients' money. He was using it to pay off other investors, creating the illusion of success. For years, this illusion held, unchallenged by the authorities or the public. As Madoff's key lieutenant, Frank DiPasquale, puts it, "We called it the magic machine. Bernie would hand me the numbers, and I'd create the statements. It was all fake." But the truth is, many people didn't want to believe it. They were so desperate for financial success that they clung to the illusion of Bernie Madoff as a genius who could make their dreams come true. The illusion came crashing down in December 2008. In the wake of the global financial crisis, Madoff's scheme unraveled. He confessed to his sons, who turned him in to the authorities. The scale of the fraud was staggering. Over $65 billion had vanished, leaving thousands of victims in financial ruin. One of his victims said, "He stole everything. My wife's medical bills, our retirement. We lost it all. And for what? So he could live like a king." In 2009, Madoff was sentenced to 150 years in prison. His fall was as dramatic as his rise, leaving behind a trail of devastation. But the questions linger. How could this have happened? How did one man deceive so many for so long? It was a perfect storm of greed, trust, and regulatory failure. Madoff was a master manipulator, but he couldn't have done it alone. The system failed at every level, from the SEC to the investors themselves who didn't ask the hard questions. Bernie Madoff died in prison in 2021, taking many of his secrets to the grave. But his legacy endures, a cautionary tale of unchecked ambition, the seductive power of greed, and the devastating impact of betrayal. In the end, Bernie Madoff's story is not just about one man's downfall. It is a stark reminder of the dark side of human nature, the fragility of trust, and what financial assets trading should be about. In the world of finance, where fortunes can be built on mere promises, it serves as a warning that even the most respected figures can harbor the darkest secrets. The history of Ponzi schemes. Think you've heard it all? Think again. For over a century, Ponzi schemes have been pulling the wool over investors' eyes like a magician's trick. It's a tale of greed, deceit, and the endless human quest for easy money. Let's rewind the clock to the wild days of the Dutch tulip mania and the South Sea bubble. These speculative frenzies, while not classic Ponzi schemes, set the stage for the financial frauds that followed. Imagine promising people a 40% return in just 45 days. That's what Charles Ponzi did, and it worked for a while. But just like a house of cards, Ponzi schemes eventually crumble. The Madoff scandal, the Stanford Financial Group fraud, and countless others have shown us the devastating consequences of these scams. In today's digital age, Ponzi schemes are more sophisticated than ever. The technology had given rise to online platforms and social media scams, with cryptocurrency-related Ponzi schemes becoming particularly rampant. These modern frauds promise astronomical returns, drawing in investors eager to cash in on the latest financial trends. But beyond the fraud, there are so many lessons we as traders can learn from the Madoff story as well as every other Ponzi. In this video, we'll dive deep into the psychology of Ponzi schemes. Why do people fall for these scams? What makes them so appealing? We'll explore the common tactics used by fraudsters, from high-pressure sales techniques to promises of guaranteed returns. We'll also discuss the red flags to watch out even for us as traders so we don't become another Madoff. 1. The power of social proof. Bernie Madoff's scheme was fueled, in part, by the powerful influence of social proof. As a prominent figure in the financial world, rubbing shoulders with the elite, Madoff cultivated an aura of legitimacy that attracted a large following. Many investors, rather than conducting their own due diligence, relied on the fact that others they respected were investing with Madoff. This blind trust based on social standing and the endorsement of peers demonstrates the dangers of relying solely on social proof as a basis for investment decisions. Madoff's social connections played a crucial role in attracting new investors. His ability to associate with high-profile individuals created a sense of exclusivity and prestige, leading many to believe that investing with him was a sign of status and sophistication. This psychological phenomenon, known as social proof, can be a powerful influence on decision-making. However, the Madoff scandal highlights the limitations of social proof. There are many Bernie Madoff right now, especially on social media, showing proof of trading earnings, claiming to have turned $100 to $150 million. And just as Madoff used his social standing to attract investors, many of these modern-day scammers leverage the power of their online presence to create an illusion of legitimacy. They may share screenshots of trading platforms showing impressive profits, claim to have turned small investments into massive returns. However, these claims are often fabricated or based on manipulated data. While social proof can be a useful tool for assessing the credibility of individuals or organizations, it should not be relied upon exclusively. In the case of Madoff, his social standing and the endorsement of others served as a smokescreen for his fraudulent activities. The lesson to be learned from Madoff's scheme is that investors should exercise caution when relying on social proof. If you intend to make an investment or pay a trading guru based on their social proof, it should be used in conjunction with other factors, such as due diligence, risk assessment, and independent analysis. When you understand the limitations of social proof, you can better protect yourself from financial scams and make more informed trading and investment decisions. 2. Greed is a powerful force. Bernie Madoff's story is a reminder of the destructive power of unchecked greed. His insatiable desire for wealth and power led him to construct the largest Ponzi scheme in history, defrauding thousands of investors out of billions of dollars. Beyond the financial implications, Madoff's actions also highlight the corrosive nature of greed, which can erode moral judgment, undermine trust, and ultimately lead to devastating consequences. As documented in the book The Wizard of Lies by Brian Tuohy and the documentary film The Untold Story of Bernie Madoff, Madoff's greed extended beyond monetary gain. It was a driving force behind his desire for control, influence, and the satisfaction of outsmarting the system. His scheme, which ran for decades, demonstrated a remarkable ability to maintain the illusion of success, even as the underlying fraud grew exponentially. The psychological impact of Madoff's greed was far-reaching. His victims, who trusted him with their life savings, suffered immense financial and emotional hardship. The collapse of his scheme shattered their faith in the financial system and left many feeling betrayed and devastated. Madoff's greed also had a ripple effect on the broader economy, contributing to the global financial crisis of 2008. Moreover, Madoff's story serves as a cautionary tale about the dangers of unchecked ambition. His rise to prominence was fueled by a relentless pursuit of success, but his downfall was a direct result of his insatiable greed. This illustrates the importance of maintaining a healthy balance between ambition and ethical conduct. Bernie Madoff's story is a powerful testament to the destructive power of greed. His actions, which had far-reaching consequences, underscore the need for individuals, especially traders, to prioritize ethical behavior, transparency, and accountability. You have been there. You opened a position, stop loss, and take profit set. Price moved in your favor. But then, something in your head suggested you can get more profit, and of course you listened. Adjusted your take profit, waiting for even more wins as the run continues. While it is a good thing to let your winners run, I don't think I need to tell you how it ends. You have experienced it already. The not-so-greedy thing to do is to take out a percentage of that profit or set a trailing stop-loss that guarantees that you are covered no matter what happens in the future. Understanding the corrosive nature of greed will help us better protect ourselves and our communities from financial disasters. 3. The psychology of investment and trading. Bernie Madoff's Ponzi scheme capitalized on a common human weakness, the dream of getting rich quick without taking any risks. He promised his clients a financial utopia where profits were guaranteed and losses were non-existent. It was a seductive proposition, especially for those who were weary of the volatility and uncertainty of traditional investments. The fear of missing out, FOMO, played a significant role in Madoff's success. His clients were convinced that they were on the inside of a lucrative secret, a financial opportunity that others were unaware of. This sense of exclusivity made them more susceptible to his deception. Moreover, Madoff's promises of consistent returns offered a sense of security and peace of mind. In a world filled with financial turmoil and economic uncertainty, the idea of a steady income stream was incredibly appealing. Many of his clients were nearing retirement age and were seeking a reliable source of income to supplement their savings, and Madoff's scheme offered them exactly what they were looking for. I know you are no Madoff and might not have the ability to pull one, but how many times have you asked for signals from a guru? How many times have you searched YouTube looking for that strategy that wins all the time? How many times have you thought about making easy money as a trader? Let's face it, we all want to get rich quick. But the desire for easy money can often lead us astray. We might start believing we're smarter than the market, or that we can always avoid losses. These are mental traps that can mess up our trades and investments. To stay out of trouble, we need to be aware of these traps. Do your homework, spread your money around. Don't put all your eggs in one basket, and think about where you want to be in the long run. When we understand the psychology of trading and investing, we're less likely to make dumb mistakes and lose our hard-earned money. 4. The seduction of consistency. The allure of consistent high returns was a key factor that fueled Bernie Madoff's scheme. In the volatile world of finance, where markets can fluctuate wildly, such consistency is a rare and often suspicious occurrence. However, many investors were captivated by the idea of reliable gains, and this blinded them to the possibility of fraud. Madoff's fabricated track record played on the human tendency to favor stability and predictability, highlighting the importance of questioning the plausibility of such perfect performances. As Brian Toohey writes in his book, The Wizard of Lies, Madoff's consistent returns were a powerful magnet that attracted all kinds of investors, from rich individuals to big institutions. The promise of steady profits without all the ups and downs of traditional investing seemed too good to be true. This psychological trick, called the consistency bias, can make us ignore red flags and make bad decisions. And this relates to you and I. We are so focused on the winning that we forget that even in our daily activities, we don't win all the time. Life is full of imperfections. We accept that in our personal and professional lives. So why should we hold ourselves to an impossible standard in trading? It's okay to make mistakes and not always win. The Madoff scandal demonstrates the dangers of relying solely on consistency as a measure of trading and investment performance. While consistent returns can be a sign of a well-managed portfolio, it's important to consider other factors, such as the underlying strategies, risk exposure, and market conditions. A track record that appears too good to be true is often a red flag that should be investigated further. We should be wary of social media gurus who claim to have achieved consistent returns over long periods, especially in volatile markets. Such claims may be based on fabricated data or selective reporting. Additionally, investors should be cautious of investment and trading strategies that promise high returns with minimal risk. Such claims are often unrealistic and may be indicative of a Ponzi scheme or other fraudulent activity. It's essential to question the plausibility of claims of consistently high returns, conduct thorough due diligence, and diversify our investments to mitigate risk. 5. The unsustainability of Ponzi schemes. Imagine building a house of cards. As long as you keep adding cards to the bottom, it stays standing. But once you stop, it crashes down. That's basically what happened with Bernie Madoff's Ponzi scheme. Madoff was basically running a pyramid scheme. He promised people big bucks, but there was no magic trick. He was just taking money from new people to pay off the old folks. It was a game that couldn't last forever. And when the 2008 financial crisis hit, people started pulling their money out. Madoff couldn't keep the game going, and the whole thing collapsed. It was a huge mess, and a lot of people lost a ton of money. It's like those late-night TV commercials promising you a miracle diet pill that will melt away the pounds without any effort. You know deep down it's too good to be true, but the temptation is there. The same goes for those get-rich-quick trading schemes. There are plenty of people out there claiming to have the secret formula to make you millions overnight. But remember, if it sounds too easy, it probably is. Don't fall for the hype. Real success in trading takes time, hard work, and a lot of patience. The market is a roller coaster. Some people get off with a fortune. Others end up in the ambulance. We want to make sure you're on the right ride, and that's why I highly recommend you watch this video. It shows why patience is the secret to making millions in trading. If you don't do anything else today, you should watch it. I am sure you would like to share this video. While you are at it, don't forget to also like and subscribe. Thanks for watching.